So today we are going to be looking at capital asset pricing model. Capping is just a continuation of portfolio theory. And one thing I must confess to you is that it's a very straightforward topic to understand. And not only that, it's very frequent in ICAN exam, usually 15 marks per question. All right. So when you see it in a question, that means it's a given that's you maybe you have the opportunity to pocket uh, close to 15 marks, if not the entire 15 marks. All right, without wasting more time, what do you understand by capital asset pricing model? The capital asset pricing model is a model designed principally to establish the relationship between expected return and the systematic risk of an asset, especially stocks or shares. Capital asset pricing model is designed to price risky assets. Risky assets are stocks or shares. Not only that, capital asset pricing model is used for determining expected return of assets. Capital asset pricing model is also used for calculating cost of capital. So these are some of the uses of capital asset pricing model. What are the underlying assumptions of capital asset pricing model? Again, this is an examinable areas in ICAN exam. Of course, it's usually come as a bonus. All right. So what are the assumptions? One key assumption of capital asset pricing model is that investors are rational. Okay, investors are rational. Utility maximizing investors. Of course, these are people, these kind of investors, they are risk averse. They do not like risk, but they want to maximize return, all right? Which is not possible in an efficient market, because if you are expected a high return, you must also be willing to undertake or to accept a higher risk, all right? That's how it works in an efficient market, all right? Number two, assumptions of capping is that markets are frictionless, including the fact that there are no taxes and transaction costs. Again, this is not realistic, okay? This is not realistic. There is no how you are going to make investing, you are going to carry out investing activities without incurring taxes, that you are not going to pay tax. Once you earn income, certainly you are expected to pay tax. Not only that, when you are investing, certainly you are going to incur transaction costs. All right, you are going to incur transaction costs. Then another underlying assumptions of capping is that investors have homogeneous expectation. Again, this is not possible. All investors cannot have the same understanding of the market. The fact that the assumption is saying that investors have homogeneous, the same expectation or belief, it is not possible in reality. It is only in theory. All right, it's only in theory, because we are different individuals with different experience, with different exposure, with different understanding of the market. Therefore, we cannot have the same expectation. Then another assumption of capping is that all investments are independently divisible. Again, to a large extent, you cannot say not all investments can be divisible. All right. There's be some investment that you have to, it's either you undertake the investment 100% or not. Not all investment is divisible. Okay. Then lastly, investors are price taker. Investors are price taker, which means that whatever the market push to the investor is what they are going to take. Okay. So these are some of the underlying assumptions of capping, and like I said, is a very frequent examinable areas. Please make sure you memorize them, and so that on that day, in case you are asked, you'll be able to do justice to it. Now, The capping model stipulate that the expected return of security equal to the expected rate of return, okay? The expected rate of return plus the risk premium. You know, in the formula of capping that you are used to, we have risk-free rate of return plus beta multiplied by risk premium. So what this is saying is that the model is based on the fact that the expected return of the security will equal to the rate on the risk-free security plus the expected plus the risk premium. Okay, the market return minus the risk-free rate of return, which of course you know as the risk premium. So, but if this expected return does not meet the required return, then it means that the investments should not be undertaken. Once you notice that once the expected return falls short below the required return, then it is not suitable to undertake the investment. Now, you're already familiar with the formula for calculating capping. Capping is calculated as risk-free rate of return plus beta multiplied by the risk premium. The difference between market return and the risk-free rate of return is what is known as the risk premium. Okay. Now, like I said, there are two phases of capping. One is talking about expected return of a risky asset. Then the other part is its systematic risk. Is the systematic risk as measured by the beta. All right, as measured by the beta. Now, we have talked about the expected return. Let's talk about the other side, which is the systematic risk, because capping believes that since unsystematic risk can be diversified or can be eliminated through diversification, then the focus generally is on the risk is on the beta, which is the systematic risk in this case. So let's talk about the systematic risk as measured by beta. So beta generally measures how sensitive is an asset return to the market as a whole. You want to know what is the tolerable extent to which the asset return can change relative to the market return. So that is basically what beta measure as far as capping is concerned. So it's a measure of how sensitive an asset return is to the market as a whole. And there are basically three types of beta. Okay, there are basically three types of beta. We have positive beta. Okay, we have negative beta. Then we also have zero beta. All right, we have zero beta. So what do you mean by positive beta? But positive beta indicates that the asset return follow the same direction of that of the market, meaning that if the return of the market is high, the return of the security or of the asset will also be high, and vice versa. That is positive beta. So like I said, the positive beta indicate that the asset return follows the same direction as that of the market. The negative beta shows that the return of an asset is in the opposite direction of that of the market. Okay? Negative beta shows that the return of an asset is in the opposite direction as that of the market. So when the return, if the return of the market is high, that of the security may be low. All right. So when the events that affect the market return will be different from the one that affect the one of the security. So they are always in opposite direction. That is what the negative beta is all about. Then what do you mean by zero beta? Zero beta indicate that there is no relationship between the asset return and that of the market. So that's just a simple explanation. Please watch out. Okay. Now, you should know that The beta of the market is always 1. Please, this is very important. Beta of the market is always 1. So what that simply means is that whenever you compute the beta of the security, you have to compare it with that of the market, which is 1. So if you have calculated beta of the security or of the portfolio and it is equal to 1.2, for example, then it means that the risk the return, the risk of the security is slightly higher than that of the market. So if it is below 1, then that means less risky relative to the market. So you need to watch out for that also. All right. So whenever you compute, because examiner can ask you to interpret your results, so you have to talk about that. All right. That is, whenever you compute your beta value, you need to compare with the value of the beta of the market. Okay. Now, how do you estimate? How do you estimate beta value? There are 5 different ways in which you can calculate, different formulas that you can use to calculate beta value. And I'm going to give it to you based on the frequency of occurrence or the frequency at which the examiner usually tests it. All right. So, and you have to memorize the 5 of them because you don't know which one the examiner will set on that day. And that's why it is important that you memorize them all. So whenever your beta can be calculated as follows, depending on the information available. So I will give it to you in order of frequency. Now, if in the question, let me see if I can get a bigger space. Okay, let me manage this one first. So if in the question you are given information on correlation coefficient, number 1, calculating beta value. So number 1, if correlation coefficient, and standard deviation are given, then in this case, your beta value will be computed as correlation coefficient multiplied by standard deviation of security over standard deviation of the market. All right. So that is the formula you are going to use. If you can see in the question, you can see correlation coefficient and the standard deviation, then in that case, that is the formula you are expected to use. Then number 2, if share price and beta, okay, let me do it this way. If share price, number of shares, okay, and beta of individual securities are given, then in this case, we are going to carry out about 3 or 4 procedures. First thing first, you need to calculate the market value. You need to calculate the market value of each security in the portfolio. Then you determine the weight of each security. Then you determine the beta value. So whenever you are given share price, number of shares, and the beta of individual security, first thing first, I will give you the formats. So you create a column for the companies in the portfolio or the companies that you have invested. Okay. You create a column for number of shares. You create a column for share price. Okay. You create a column for market value. You create another column for beta value. Then you create a column for weight. Excuse me. So it creates equilibrium for the weights. So let's say this is A, this is B, C is equal to A times B. Say this is D, then this is E. E is equal to C times D. C times D. Let me push it to the front. Okay. Say you have about 3 securities in the portfolio, security A, B, and C. So total. So you include the number of shares of each security, the share price or the market price per share. When you multiply together, you get the total market value. Okay? Total. Then the beta value of individual security will surely be given to you if an examiner wants you to use this method. Then, to now get the weights, you are expected to multiply the market value, the total market value with the beta value of individual security. So you total everything together, then you then go ahead and calculate the overall beta, the beta of the portfolio, which is computed as the total weights divided by total market value. So this will give you the overall beta of the portfolio. This is the second most frequent tested formula for calculating the overall beta or beta value. Okay, then the third one, number 3, if covariance and variance are given, then in that case, the beta will be computed as the covariance of security of the markets over variance of the market. Then number 4, if you are given regression analysis information, then in this case, if you are given regression analysis information, let me put it down. If regression analysis information is given, then in this case, the beta value will be computed as n summation xy minus summation x multiplied by summation y divided by n summation s squared minus summation x all squared. So this is the regression analysis information that you are going to use. Okay, this is the formula for regression analysis. You recall in statistics, this particular formula is meant for slope. Okay, it's meant for slope. N is the number of the period. It could be, period can be in a month, it can be in years, depending on what examiner has given to you. The X is the return on the market. YY is the return on security. And the last one, the last formula that you can use to calculate beta value, number 5. If you are given excess return, if excess return on security, excess return on security and on the market are given. Let me write that. If excess return on security and of the market are given. So in this case, beta value will be computed as excess return on security, which is the expected return minus risk-free rate of return over excess return on the market, which is market return minus risk-free rate of return. Okay, so these are the 5 formulas you are expected to use that you can use to compute your beta value. So depending on the information available on that day, so one of them will be useful for calculating the beta value. Okay, and because you don't know where examiner will come out to you, and that's why it is important that you memorize all of them. Okay, and like I mentioned, capping is a very frequent topic being tested by ICAN. So please don't underrate it. Don't underrate it. And it's always a bonus. All right. So one more area we need to touch before we go for calculation is alpha value. Okay. And this is very practical. So let's talk about alpha value. I'm not sure it's in this material. Okay. Let me find a space. So, okay. Let's talk about alpha value. Calculating, this will be sufficient for me. I will manage it. Okay, calculating alpha value. What do you mean by alpha? Alpha represents the difference between the expected return and the required return of an asset. Okay, of an asset in a portfolio. In a portfolio. Okay, it can be calculated as follows. Now, whenever you want to compute alpha value, first thing first, you need to calculate, you need to go ahead and calculate the beta value, because in most cases, the beta value may not be given to you. So you are going to calculate the beta value using any of the 5 formulas I just gave to you. Then thereafter, you proceed to calculating the required return. The required return is the risk, is the capping. Then thereafter, you then calculate the alpha value. So the alpha value is simply the difference between the required expected return and the required return. Like I said, alpha is calculated as expected return minus the required return of assets in the portfolio. So let me give you the formats that you can use to calculate your alpha value. So whenever you want to compute alpha value, of course, you are going to list out the companies that you want to invest in the portfolio. So you create a column for expected return. You create another column for the required return, okay? Using capping, then you create another column for the alpha. If you like, you can create additional column for comments on your results, okay? Let's say you have 3 securities in the portfolio. Before then, let me just put this one down. Let's say this is A, this is B, this is C equal to A minus, it is always A minus B, not B minus A. All right. So let's say, for example, you have 3 securities in the portfolio, security A, B, and C. So the expected return will always be given to, in most cases, the expected return will always be given. It will be given to you. The only thing the examiner will never give to you is the required return as far as alpha value is concerned. The required return will not be given to you, but the expected return will always be, in most cases, will be given to you. So, like I said, the required return is simply the capping. All right, it's simply the capping. Okay, so you then go ahead to calculate the required return. come and post it there. So find the difference between the two to get your beta value. Then you now comment on your result. Now, whether examiner asks you or not, whenever you have computed your alpha value, you need to interpret your result. It is very important. You can't just calculate alpha value without interpreting it. You need to advise what the investor will need to do because you are still in a position of a portfolio manager. So you need to advise your clients on what they need to do with the results you have achieved. All right. Therefore, let me put it down here. Interpretation. Interpretation. So basically, there are three ways you can interpret your results. Interpretation. Okay. So depending on the alpha value calculated, number one, if A is greater than B, if expected return is higher than the required return, then it means the shares are undervalued. So if the shares are undervalued, what are you supposed to do? Of course, because the shares are undervalued, then more of the shares should be bought. You need to buy more so that tomorrow in the future, once the price increases, then you dispose it off, you make more money. All right. So when the shares are overvalued, then therefore the shares, more of the shares more what's wrong with you again? Don't start it. More of the shares should be bought. Please watch out for this. Alpha is the more for the past its diet. It has always been alpha value. So watch it out. This is the area you are going to see on the day of your exam. If question on capping will be tested, is in this area. Then number two, if expected return is less than the required return, of course, usually this will give you negative alpha. So once you have negative alpha, it means, okay, it means the shares or the security, it means the securities are overvalued. So if the securities are overvalued, what are you expected to do? What are you supposed to do? You dispose it off. All right. Hence, the shares should be sold. That's what you need to do. That will be your advice. Then number three, if the expected return is equal to the required return, it means the securities in the portfolio, the securities are properly priced, are properly or correctly or rightly priced, or value, since I'm using valued. So because they are properly valued, what are you supposed to do? The securities should be kept, all right? The shares should be kept. That is, the company should hold on to the shares. So these are the three ways in which you can interpret your alpha value. Please watch out. Watch out. All right. So that is basically capping. These are the things you need to know about capping. If you have the golden book, you can read more. You have further, but in summary, this is all about capping. So at this point in time, let's have illustration to demonstrate our discussion so far. Before we go into calculation, let me know if you have any question for me. Yes, sir. Okay, I can hear you. So, do you have any questions so that we can move to illustration? All right. So let's have this illustration number 2 for a start. Illustration number 2. I need one of you to read. Who is helping us? Who is helping us to read? Women, how are you?
Fine. Good evening, sir.
Good evening. Yes, who is helping us to read? Mr. Roberts, you are welcome. I miss you.
Thank you. I'm a little bit
Yeah.
free now until the exam, so I'll just try and
Okay.
make up
Oh,
time.
that's good. That's
Okay,
good.
let me
Good
read
to.
it.
Okay,
Illustration
please.
2.
All right.
Prince Fernandez, a valued client of your stockbroking firm, has advice for your advice on his investment portfolio. He holds the following securities in the stock market, having the listed risk characteristics shown below, which is regarded as efficient. So we have it displayed. The staff of the investment department of your firm has estimated the expected return on shares in general on the basis of past return and inflationary expectation to be 20%. It is expected that the risk premium will be about 5%. The risk of the market as measured by standard deviation is 8%. All the three shares lie on the securities market line. As a prelude to your advice, prepare the following computations for a discussion with your clients. The expected return of your client's portfolio, the risk of the portfolio. I think that those are the two questions. I don't know there's a third one. Assuming the
Yes.
capital asset pricing model approach.
Yes, thank you very much. That is a question. This is a very straightforward question, and this particular question has been tested twice in the past, but it's a very old question. All right, so you are asked to determine the expected return of your client portfolio. You want to calculate expected return on the portfolio. Examiner was specific in this question by telling you that you should use capping approach. Because, of course, once you mention expected return on your client portfolio, student might go ahead and be using portfolio, the normal thing you do under portfolio, but in this case, examiner wants you to use capping. Now, let me stop sharing this because of time and move to the working notes. Okay. So Prince Fernandez, solution to illustration number 2. Page, I think that's page 88. Page 88. So Prince Fernandez. All right. So in this particular question, the examiner wants you to calculate expected return on portfolio using capping. What are you supposed to do? You want to calculate expected return on portfolio. Generally, to get expected return, you are supposed to calculate capping. That's what you are supposed to do. But in this particular question, the examiner has given you the weights. You are given the proportion of the amount invested on each security in the portfolio. So what that means is that once you have computed the expected return of each security in the portfolio using capping, then you need to weight it. You need to weight it based on the figures, based on the amount invested on each of the projects in percentage, based on the percentage invested in each security. So that's all you need to do. However, the expected return will not be computed if you don't have the beta value. In this particular question, you are not given beta value of individual security in the portfolio. Therefore, you must first of all estimate the beta value. Your first working that you are going to do will be to calculate beta value. Once you are done with beta value, you can then proceed to calculate your capping. Once you are done calculating capping, then you now calculate the return of the portfolio, okay, using the weights as given to you. Then number two, you are expected to calculate the risk of the portfolio. To get the risk of the portfolio, since you have already calculated the risk of individual security, then to now get the risk of the portfolio, just multiply the weights of individual security with the risk of individual security. You add everything together, it will give you the return, it will give you the risk of the portfolio. It's as simple as that. Now, how do you then calculate? How do you calculate the beta of individual security based on the information? Please open to the material at your end. How do you calculate the beta of individual security based on the information given? So as far as this question is concerned, you can see that you are given standard deviation. You're also given correlation coefficient, which means that you are supposed to use the first formula I gave to you earlier. Okay, you use the first formula. So without wasting time, so there's no need for you to say, I just want to show you, since correlation coefficient, let me do this way, calculating beta value, calculating beta value. So since correlation coefficient and standard deviation of individual security are given, the formula below will be used to compute the beta value. Okay, so in this case, I would then say beta value equal to correlation coefficient multiplied by the standard deviation of security over standard deviation of the markets. Okay, then I will do for security X. I'll calculate beta of X. So I'll go back to the question. What's the correlation coefficient of X? The correlation coefficient of X is 40%, which is 0.4. Then the standard deviation of X is 15%. Okay, so 0.4 multiplied by 0.15 over the standard deviation of the markets. So what's the standard deviation of the market according to the question? Please check for me. So you are told that the risk of the market as measured by standard deviation is 8%. Okay, so here is 0.08. Therefore, for X, what's the final answer? 0.4 multiplied by 15, then divided by 0.08. What do you have there? 0.4 multiplied by 0.15 equal, error. 0.4 multiplied by 0.15 equal divided by 0.08 equal 0.75. So the risk of security X is less than 1, which is 0.75. I will do for Y. The correlation coefficient of Y is what? That's 60%. Standard deviation is 14%. 0.6 multiplied by 0. Standard deviation is 14%. 0.14 divided by 0.08. This will give 0.6 multiplied by 0.14 equal divided by 0.08 equal 1.05. So the risk of security Y is slightly higher than that of the market. Then security Z, correlation coefficient is 80%, then standard deviation is 5%. 0.8 multiplied by 0.05 divided by 0.08 equal. So 0.8 multiplied by 0.05 equal divided by 0.08 equal. That's 50%, 0.50. So this is lower than that of the market. Now that you have calculated the beta value of individual securities, so you also need to calculate the expected return of individual security. So number 2, expected return, calculating expected return of individual security using capping. Okay. So in this case, expected return will be computed as the risk-free rate of return plus beta into market return minus risk-free rate of return. So for security X, what is the risk-free rate of return in the question? What's the risk-free rate of return, please? What's the risk-free rate of return? Yes. According to the
I'm saying
question,
this risk premium as 5%, so we're supposed to deduct it from something. I'm just trying to see.
So you can see in this question that risk-free rate of return is not given,
Yeah.
but you are given
The
the
premium.
market return. You are given market return to be 20%. How do you know it's market return? Examiner told you that the staff of the investment department of your firm has estimated the expected return on shares in general. General means markets. In general, on the basis of past return and inflationary expectation to be 20%. So the return of the market is 20%. Okay. He also told further that it is expected that the risk premium will be about 5%. So you are given return of the market and then the risk premium. So in that case, you are going to use the known variable to get the unknown variable. So before I begin to do that, let me quickly come here to say the risk, since the risk-free rate is not given, risk-free rate of return is not given, okay? Because it is not given, so you are going to use this formula to get your risk-free rate of return, because in the question, look at, you are looking for risk-free to get your capping, you need risk-free rate of return. Unknown is not given to you. All right. You already have the beta value of individual security. We've already calculated them. All these three values are the beta value, so we don't have issue with that. The market return is given as 20%. Okay. Then the market risk premium, the risk premium is given as 5%. Therefore, you should be able to use this one to get your the risk-free rate of return. Therefore, your risk-free rate of return will then be equal to the market return minus the risk premium. Okay, minus the risk premium. So this will give you the risk-free rate of return. Therefore, RF will then be equal to 20 minus 5%. So RF is 15%. So now that you have the RF, then you can proceed to calculate your expected return of individual security. Therefore, for X, the risk-free rate of return is 15. Beta of X is 0.75. The risk premium is 5. Therefore, what do you have there? 0.75. 0.75 multiplied by 5 equal, then plus 15. Plus 15 equal 18.75%. That's the expected return on security X. You do for security Y. Risk-free rate of return is 15 plus the risk of security Y, which is 1.05, multiplied by the expected the risk premium of 5. So what do you have here? Here would be 1.05 multiplied by 5 equal, then plus 15 equal 20.25. So that's the expected return on security Y. Then on security Z, risk-free rate of return is 15 plus 0.50 into 5. This will give us 2.5 plus 15 will give us 17.50. So now that you have calculated the risk of individual security as your beta value, you've also calculated the expected return of individual security using the capping. Then in that case, you can proceed to calculate the return of the portfolio according to the requirements. So requirement number 1, calculating expected return of the portfolio. So in this case, the return of the portfolio will be computed as the proportion invested on each security, okay? Security X multiplied by the return on security X plus the proportion invested on security Y multiplied by the expected return on security Y plus proportion invested on security Z multiplied by expected return on security Z. So that will give you the return of the portfolio. So RP, we then go back to the question. 30% is invested on security X. So 0.30 multiplied by expected return on security X. We calculated 18.75. Plus, we invested 40% on security Y, multiplied by expected return on security Y, which is 20.25. Plus, we invested 30% on security Z, multiplied by expected return on security Z to be 17.50. So, return of the portfolio will then be equal to, bring out your calculator. From your calculator, open a bracket. All right, 0.3 multiplied by 18.75. Close the brackets. Okay. Plus, open another bracket. Let me redo it. Open a bracket. 0.3 multiplied by 18.75. Close the brackets. plus, open another bracket, 0.4 multiplied by 20.25, close the brackets, plus, open another bracket, 0.3 multiplied by 17.5, close the bracket, equal, that's 18.975. This is 18.975%. So return of the portfolio is approximately 19%. That answers the first requirement. The second requirement says you should determine the risk of the portfolio. So calculating the risk of the portfolio. Okay. As measured by the beta value we have computed. Therefore, the risk of the portfolio will be computed as the weight of individual security, the weight of individual security multiplied by the weight of security X multiplied by the beta value of security X plus the weight of security Y multiplied by the beta value of security Y plus the weight of security Z multiplied by the beta value of security Z. So that will give you the risk of the portfolio. 30% multiplied by 0.75 plus 40% invested on Y multiplied by the beta value of Y, 1.05 plus 30% invested on Z multiplied by the risk of Z, which is 0.50. Therefore, the risk of the portfolio using capping, then let's use our calculator, open a bracket, 0.3 multiplied by 0.75, close the bracket, plus, open another bracket, 0.4 multiplied by 1.05, close the bracket, plus, open another bracket, 0.3 multiplied by 0.5, close the brackets, then equal to, that's 0.795. Okay, this is 0.795. So the risk of the portfolio is approximately 0.8. That's it. That's end of the question. That's what the examiner wants you to do. And that's what we have done. It's as simple as that. You can see in this particular question, the examiner wants you to calculate the risk of the portfolio, the expected return of the portfolio and the risk of the portfolio. But you can't just go ahead and calculate the risk of the portfolio and the expected return. So there are procedures. So the first thing we did was to calculate the risk of individual security as measured by beta value. Okay? Because in the question, you are given correlation coefficient and standard deviation. And that's why we use this particular formula to calculate the beta value. Once we are done calculating the beta value, we then proceeded to calculating the expected return of individual security using capping formula. All right, using capping formula. So now that we have gotten the capping formula, we now decided to calculate to answer the requirements. The first thing we did was to calculate the expected return of the portfolio, because examiner wants us to use capping method. So after you have calculated the capping, just multiply capping of individual security with the amount invested in percentage on each security, and we got overall of 19%. We did the same thing for the risk of the portfolio using capping method. So just multiply the proportion invested on each security with the beta value of individual security. You add everything together, which will give you the risk of the portfolio. So that's the end of the question. Let me know if you have any question for me before we move to another illustration, please. Yeah.
There's a lot to understand, but well, maybe after one has looked at it after the lectures, one will get a grip because there's so much to understand. Not the arithmetic. The arithmetic is not the problem. It's just what to
The
pick
concept.
depending on the right time. Yeah. So
Yeah.
there's a lot to grasp
Yeah.
because if the formula is saying multiplying, I'm looking at the formula now, multiplying
Yeah.
correlation of coefficient by say standard deviation.
Division of
I
security.
had in practicing why are we multiplying it? I think that is the extra work one has to do. I don't think I will get it immediately. Maybe
It's
after
not
the
a policy.
class.
Of course, like that's what I said the other time. All you need to do, you must understand the fight. Your starting point, after reading the concept, your starting point is to understand the formulas. Once you're able to memorize those formulas, you don't have any issue. Because once on that day of your exam, once you are given a question on capping, you will see it there. You will surely, your mind will go to the formula you are expected to use. Immediately, you just write it down on your answer booklet. So that's how it works. Once you understand the formula, you are good to go. You have to memorize them all. And you can imagine a bonus question for it to usually come as a bonus is 15 marks maximum, just like a risk management, where the currency risk management, the interest rate risk management. It's also a frequent topic. ICAN usually test, and it's also 15 marks kind of question. So, all right, let's move on to another illustration. Let me stop sharing this. Okay. Let's have this before we go to alpha. Yeah. Let's have this illustration number 3. An average student can struggle to solve this question if care is not taken. Because if you don't understand the requirements, then you may struggle. All right, you may struggle to solve it. So quickly, let's have a look at this question. Yes, I need somebody to read for us. Yeah. Yawa, you want to try it? You are the first to, you and Biola are the first to join the class today. So, Yawa, you want to try?
I'm driving, sorry.
Oh, okay. No
I'm
worries
on the
then.
road.
It's
Thank
okay.
you.
Yeah, Biola, you want to try? You want to read for us? You are the first comer today. Biola, are you there or you are attending a class by proxy? Diamond, read.
So company X has a project
Thank
with
you.
a lifespan of 1 year. While company Y has 3 projects in different industries, each lasting 1 year. The net cash inflows and beta factors associated with the project are as follows. So we have it on the table. The market return is 10%, and the risk-free rate of interest is 5%. Required, calculate the total present value of projects undertaken by company X, company Y. Determine the overall beta factor of company Y, assuming that all the projects are undertaken. Explain how portfolio diversification reduces the risk experienced by any investor.
Thank you very much. So that is the question. From the requirements, you have to calculate the total present value of projects undertaken by each company. So you want to calculate present value. And you know that present value is computed by multiplying cash flow with the discount factor, isn't it? You recall that when we did capital budgeting, we calculate NPV. To get your NPV, we said NPV is the difference between the present value of cash inflow and the present value of cash outflow in capital investments. So to get the present value, you multiply cash flow with a discount factor. That's all you need to do. So in this case, let me just switch. Let me switch. Okay. Solution to illustration 3, page 89, I think. Let me confirm. Yes, page 89. So in this question, you are expected to calculate market value. I would then say calculating present value. Present value is the same thing as market value. Present value, PV. So, and you know that PV, like I said earlier, PV is computed as summation of cash flow, okay? Summation of cash flow multiplied by discount factor, multiplied by discount factor. So I can rewrite this to say PV equal to summation of cash flow multiplied by discount. You know that discount factor is 1 plus R raised to power minus N. All right. So in this particular question, for company X, I want to calculate present value for company X. So PV will be equal to what's the cash flow of company X. Company X has only one project, all right? And then the cash flow of that project is 100 million, okay? It's 100 million. Therefore, here will be 100 multiplied by, and we are told that each of the projects has 1 year life, all right? Each of the projects has 1 year life. So in that case, I need to go back to the question, am I given cost of capital? You know, for you to have your discount factor, you must be given cost of capital. But in this particular question, we are not given cost of capital. How do you then estimate it? You will recall I mentioned earlier today that capping is used for pricing risky assets, generating rate of return on security, as well as computing or calculating cost of capital. So since you are not given cost of capital in this question, what information do you have to compute your cost of capital? You are given the risk-free rate of return. You are given market return to be 5%, to be 10%, risk-free rate of return to be 5%. You are given beta value of individual security. Then in this case, you can calculate your the expected return of each security using capping. Your capping is your cost of capital. That's all you need to do. Therefore, let's calculate cost of capital first. I will go and do my work in somewhere. Okay, or let me, okay, I will do for, let's say this would be for X, then Y. All right, let's go ahead. Let me push down. Let's say our working will be here. So I want to calculate expected return of individual security. So calculating capping for each. Okay, just to calculate capping. So and you know that capping denoted as RS is calculated as risk-free rate of return plus the beta value multiplied by market return minus the risk-free rate of return. So for company X, Okay. For company X, risk-free rate of return according to the question is 5%. The beta of company X is 1.2. Beta of company S is 1.2. Market risk premium, market return is 10% minus 5. So what do you have here? 1.2, 1.2 multiplied by 5 equal, then plus 5, that's 11. So 11% is the expected return of security Y, of security X. Then you now do for company Y. Company Y has 3 projects. So project 1 will be equal to 5. Risk-free rate of return is 5 plus the beta value of project 1 is 1.5. 1.5. Difference between 10 and 5 is 5. Again, the beta we do for project 2. 5 plus is the same thing for project 2, difference of 5. Then project 3, 5 plus the beta value of project 3 is 0.9. 0.9 into 5. So what do you have here? 1.5. 12 points.
5.
Okay, here is 12.5%. 12.5%. Then here will be that will be 9.5. 9.5%. So this represents the capping or rate of return or expected return of individual security in the portfolio. Now that you have it, I can then proceed. So this will now represent the cost of capital. So I can then proceed to calculating the present value. And you recall that present value is the same thing as market value. So for security, for company X, we calculated 11%, cost of capital of 11%. So 11%, that will now be 1.11 raised to power minus 1 because the useful life of the project is 1 year. So equal to, then bring out your calculator to say that 1.11 raised to power 1 minus equal, then multiply by 100 equal, sorry, that would be 90.1. 90.1, so 90.10 million. Figures are in million. Okay, figures are in million. So that is for projects company X. Then for company Y, there are 3 projects in company Y. Okay, so projects PV of project 1 equal to the cash flow of project 1 is 25 million. Here is 25 multiplied by the capping of project 1 is 12.5%. So that will be 1.125. Okay, raised to power minus 1. Because again, the useful life of projects of the projects in company Y is 1 year. So from your calculator, what do you have?
22.22.
22.22 million. Okay, figures are in million. So the same thing for project 2, 25 multiplied by 1.125 raised to power minus 1 equal to 22.22. Then for project 3 has 50 million cash flow multiplied by 1.0. What's the cost of capital of that one? I think is 99.5. So 1.095. 0.95 raised to power minus 1. So what do you have here?
45.6.
45.66. Okay. So when you add it up, this will produce 90.1 90.1. This is 4. This is 10. That's 11. Yeah. So that's 90.1 total present value. Total PV. Total PV for company Y is 90.1 million. So that answers the first requirement. I will then go back to the question. What's the second requirement? You have to determine the overall beta factor of company Y, assuming all the projects are undertaken. Okay, so in this case, requirement number 2, calculating overall beta. Let me write it. Overall beta value. Okay. So you want to calculate overall beta value. How do you do this? Based on the information available, how do you calculate the beta value? So you need to shine your eyes. You will recall that in this particular question, the examiner has given to you the beta of individual security in the portfolio, but you are not given, you are asked to calculate the beta of the portfolio. So in this case, what are you supposed to do? Which formula are you going to use? Earlier today, I gave you 5 different formulas that you can use to calculate your beta value. One of those 5 formulas are what you are going to use. So in this particular question, which of them do you think we are supposed to use? Which of the formulas? Talk to me. Which of the formulas do you think is more appropriate to calculate the overall beta? I listed number 1 to 5. So give it to me based on the order, at least that I listed. Which one do you think is more appropriate? Yes. Are you still there? Now that I ask question, all of you muted.
No, why, yeah, I'm just looking at the notes you gave. So see, I'm looking at your notes. Like I said before, for me, the concept, I have to understand it. I'm just doing the arithmetic. I don't understand the concept very well yet to piece it together. But I'm
It's
looking at your
expected. You are
notes to
just
see
learning
which
afresh.
one.
So yes,
Yeah.
I told you earlier today that we are going to use the second formula, because in this question, even though you don't have number of shares, you don't have share price, but you have market value. Present value is the same thing as market value. So if you have calculated market value, all these are the market value. If you have calculated market value, an examiner has also given to you the beta value of individual security, then of
So we
course
can calculate the weights.
so you are
Okay.
going to get the weight now. So once you have the weight, then you get your overall beta. That's all you need to do. So you have to shine your eye. You have to shine. You must know the next thing. The question will surely tell you the direction you should follow. All right. So in this case, let me just give a note.
This number 2 is not in this relevant formula. This number 2 you gave is not in this note. Maybe it's in the golden book, but it's not in this one.
Yeah, but that's what I gave it to. That's what I wrote it down in
okay.
so that whoever that doesn't have the golden book will be able to read it through. Okay, since the market value has been computed for each project in the portfolio, or for each project of company Y, and the beta value of individual projects is given. The formula below, or the overall beta value will be computed as follows. Okay. Yes. Ufoma, you raise and talk to me.
Please, I beg. Maybe after the class, can this video be shared tomorrow so that we'll go through it?
No problem. I will follow up to ensure that it is shared. All right. So you create a column for projects. Okay. You create a column for market value. There is no need for you to put number of shares, share price again, since you've already calculated your market value, which is the same thing as your present value. All right. Then you create a column for the beta value of individual security as given to you. Then you create a column for the weights. Therefore, we have projects 1, 2, and then 3. Market value of project 1 is 22.22. 22.22. Then 45. 45, let me confirm. Yes, 45.66. 45.66. Okay. In this case, here is 90.10. So we're also given the beta value of individual to be, I think 1 point, what did we, let me check here. Beta value is 1.5. Here is 1.5, 1.5, then 0.9. So to now get the weights, we are expected to multiply the market value with the beta value. Therefore, 22.22 multiplied by 1.5. 22 multiplied by 22.22.
33.33.
23.33.
33.33.
33.
Yeah.
Okay. 33.33. 33.33. Then for project 3.
41.09.
41.09. Add it up. 107.775.
107.75.
Okay, so that's that. So, of course, this is total. In this case, the overall beta will then be computed as the total weights over total market value. Okay, which is equal to 107.75 divided by 90.10. So what do you have there? That will be
1.20 approximately.
1.2. So the overall beta, I would then say the overall beta, you need to explain the overall beta of company-wide portfolio portfolio is 1.2, which is higher than that of the markets, which is higher. Let me write this. Higher than that of the markets. That is 1. Okay, so that's what the examiner wants you to do, and that's what we have done. Okay, let me see. Determine the overall beta, assuming that, so that's it. Then number C, you have to explain how portfolio diversification reduces the risk experienced by any investor. How do you reduce portfolio risk? Through diversification. To reduce the portfolio risk through diversification, a rational investor should invest in securities that are negatively correlated or securities with no correlation. Investor can also engage in geographical or international diversification. So that will reduce the risk of the portfolio. So that's that. So let's go to alpha. Let's go to a question on alpha. All right. There are so many examples in the Golden Book that you can practice on your own. Okay. Let's solve this illustration number 7. 7 and then illustration number 8. Illustration number 8 and then 9 are similar, but we're only going to solve this illustration number 9. That one is more slightly technical than the number 8. Then let's start with this illustration number 7. So you already have the answer to the A parts. The assumptions of capping, which I listed earlier today. Okay. So you can just go through that. Then number B, we are now told that currently the rate of return on the federal government bond redeemable at par in the year 2018 is 5%. The securities of 4 companies, Akira PLC, Bombardier PLC, Courage PLC, and Divine PLC, have expected return of 12%, 9.5%, 10.5%, and 13% respectively. The average expected return on market portfolio is 10%. So the return of the market is 10%. That is the RM. Subject to a 6% risk, that is standard deviation. So you have been given that standard deviation of the market to be 6%. Other relevant information relating to the 4 securities of the companies is as stated below. You are required to show which of the companies is or are overvalued. So this is a very straightforward question. In most cases, examiner will not tell you to calculate alpha value. It is implied in the question. Two things that there are two different ways that you can deduce whether the question relates to alpha or not. If in the question you are given expected return of individual security, then you need nobody to tell you that you are going to calculate alpha value. Once you see expected return on individual security in a question, it means that you are expected to calculate the alpha value, because examiner may not tell you to calculate alpha value. But another way is that examiner may be very liberal. If in the question you are in the requirement, you are seeing something like overvalue or overpriced, when you are given underpriced, overpriced, all of that, then in that case, that's another indication that you are supposed to calculate alpha value. All right. So those are the two different ways. Now, you want to calculate, examiner is asking you to advise whether to advise which of the companies is or are overvalued. So that means you want to calculate alpha value. How do you do this? Very simple. Very, very simple. The first thing you are going to do is to calculate the beta value of individual security. Okay, you calculate the beta value of individual security using any of those 5 formulas I gave. Then 2, you calculate the required return of individual security using capping. Then step 3, you go ahead to calculate the alpha value. Alpha value is the difference between the expected return as given to you minus the required return, the capping you just calculated. So the difference, we give it alpha value. Once you have your alpha value, then you interpret your result. It's as simple as that. It's not difficult. So let me stop sharing this and move to the working note. Okay. So solution to illustration. What illustration is done? Illustration number 7, page 91. Okay. So number B, calculating alpha value. Okay. That's what we want to do. So you can't just proceed to calculating the alpha. There are procedures you are supposed to follow. So if in the question you are not given the beta value of individual security, that's your starting point, like in this case. So I would then say calculating beta. Step 1, you calculate beta. So the beta value you are going to compose will depend on the information available. So in the question, examiner asks, how are you going to calculate your beta value? According to the question, you are given standard deviation and correlation coefficients. Okay, in that case, your beta value will be computed as the correlation coefficient multiplied by the standard deviation of security over standard deviation of the market. So for Akira is denoted as A. Okay. Akira is denoted, let me just write it out in full. For Akira, the correlation coefficient of Akira is what? That's 0.975. Please be giving me the number. 0.975. Standard deviation of Akira is what?
0.080.
0.080 divided by the standard deviation of the market. According to the question, the standard deviation of the market we are told is 6%.
6%.
Yeah, 6%. So 0.06. Give it to me. What do you have? Multiply, please.
1.3.
Pardon?
1.3.
1.30. Okay. Then for Bombardier, what's the correlation coefficient of Bombardier?
0.640.
0.640 multiplied by the standard deviation of Bombardier,
0.075.
0.75 over 0.06. What do you have there?
0.8.
0.80. Then you do for courage. Correlation coefficient of courage,
0.740.
0.740.
0.740. Standard deviation of courage,
0.090.
0.090. Let me rewrite it. Over 0.06. What do you have there?
1.11.
Okay, 1.11. Then you do for define. Divine. Correlation coefficient of divine,
0.680.
660.
680.
Okay. Then standard deviation of divine,
0.150.
150 over 0.06. What do you have?
1.70.
1.70. So that's that. Now that you have computed the risk of individual security as measured by the beta value, we need to go ahead and calculate the required return. Okay. So calculating required return. RS. Okay. So RS is calculated as capping, which is the risk-free rate of return plus the beta into market return minus the risk-free rate of return. So for AHIRA, what's the risk-free rate of return as given in the question? Risk-free rate of return is 5%. You are told that currently the rate of return on the federal government's bond redeemable at par in the year 2018 is 5%.
Yes,
You
it's
recall
5%.
that the risk-free rate of return is the rate of return associated with government security. In this case, is 5%, and the market return is 10%. So here is 5 plus the beta of AHIRA. Beta of AHIRA we computed is 1.3. 1.30. The market return is 10. Risk-free rate of return is 5. Give it to me. What do you have? Yes. 1.3 multiplied by 5.
7.0.
Pardon?
7.
7. It can't be 7 now. 1.3 multiplied by 5 plus 5.
Okay, plus 5. So
11.5.
11.50.
11.50.
Okay, percent. Then for Bombardier, the beta of Bombardier is 0.8. 0.80 multiplied by 5. 10 minus 5 is 5. So this should be 9%. Then for courage, 5 plus the beta of courage is 1.11 into 5. What do you have?
10.55.
10.55. Then for define is 5 plus 1.7 into 5. What do you have?
13.5.
13.5%. So now that you have computed the required return of individual security, you can then proceed to calculate the alpha value. I would then say calculating alpha value. And you know that alpha value is computed as expected return minus the required return. Okay? So in this case, I will list it out. Companies, create a column for expected return, required return, then the alpha value. If you like, you can comment or you put a remark. So this is A, this is B, C equal to A minus B. So we have Akira, Bombardier, Courage, then Divine. Okay, so give me the expected return, give it to you in the question. Expected return?
Percent.
Pardon?
Akira 12%.
12,
9.5.
9.5,
10.5.
10.5,
13.
and then 13. So we have calculated the required return to be 11.59, then 10.55,
13.5.
13.5. So 12 minus 11.5, what do you have?
0.5.
0.5. 9.5 minus 9.
0.5.
0.5. 10.5 minus 10.55 minus 0.05. Am I correct?
Yes.
Then 13 minus 10.5 minus 0.5. All right. Once your alpha value is positive, it means it is undervalued. So here is undervalued. Let me push the space. Undervalued. So if your alpha value is negative, it means it is overvalued. Okay. Overvalued. Undervalued. This is just a guide. That's not what the examiner wants you to do. Examiner is asking you to advise which of the securities is or are overvalued. So in this case, you don't need to talk too much. You have seen that Courage and Divine, the shares in Courage and Divines are overvalued. Then come here. The shares encourage PLC and divine PLC are overvalued. Therefore, the shares should be sold. That's it. That's what the examiner wants you to do. 9 marks, you pocket it. All right. So that's that. There's no need for you to comment on Ahira and Bombardier. If you comment on it, no problem. But examiner was specific in this question. You have to determine the ones that are overvalued. And that's what we have done. So that's the end of this particular question. Let's have one more illustration for alpha. Let me know if you have any question on this before we switch to the question. Okay, so let me stop sharing. So let's have the last illustration. Like I said, this illustration number 8, similar funds, is technically almost the same thing as illustration number 9. Okay, but we are solving the illustration number 9 because in this illustration number 9, the expected return is not given to you, but there are information for you to do it. And that's why I don't want to solve this illustration number 8. All right. So you can practice the illustration number 8 on your own based on the one we want to solve now. So let's go through illustration number 9 together. Somebody should help us read. Who is helping us?
I'll read.
Okay, thank you.
Balloon PLC has been enjoying a substantial net cash inflow. The funds have been invested in a small portfolio of short-term equity investments until they are needed to meet tax, dividend payments, and to finance further capital expenditure in several months' time. Details of the portfolio, which consists of shares in 4 Nigerian listed companies, are shown below. All figures stated as correct. The yield on treasury bills is 11% a year, and the market return is 19% a year.
Okay.
Should I read required?
Yes, go ahead.
Okay. Required, based on the data given, calculate the risk, that is beta, of Balloon's short-term investment portfolio relative to the market, 4 marks. B, recommend giving your reasons whether the composition of the company's short-term investment portfolio should be changed. Relevant calculations must be shown, 6 marks. C, discuss the factors that a financial manager should consider when investing in marketable securities, 5 marks, total 15 marks.
Sorry, I didn't know that I was muted. Can you hear me, please?
Yes, sir.
Finally.
All right, thank you. Sorry about that. My network was misbehaving. That's why. So solution to illustration 9. Page, is that not page 90? Let me confirm. That's page 92. Balloon PLC. So in this particular question, requirement says that determine the risk, that is the beta of Balloon's short-term investment portfolio relative to the markets. So based on the data given to you, so you want to calculate beta value. So consistent with the information in the question, how do you compute your beta value? Okay, how do you compute the beta of the portfolio? You see that you are given the beta of individual security. That's equity beta coefficient. You are given for Dashing PLC, Elegant, Fantastic, and Godi PLC. But examiner is asking you in the A part of the question to calculate the overall beta. All right. So to get the overall beta, which information or which formula are you going to use to do that? You will notice that in this question, you are given number of shares. You are also given the market price per share. In that case, you are going to use the second formula to compute the overall beta. That's what you need to do. So in this case, I will then come here, calculating number A. Is it A or number 1? I think it's A. Let me see. Yes, number A. So you then say overall beta. Okay, denoted as B. Since information, there is no, on the day of your exam, please, there is no need for you to be writing this. I'm only writing this because of your own understanding, so that it will be clearer to you. Since information on number of shares, share price, and beta value of individual security are given. The overall beta value will be computed using the weighted average method as shown below. Okay, so the first thing you are going to do is to calculate the market value. You calculate the weighted average value, then you calculate the beta. So create a column for company in the portfolio. You are going to have column for number of shares. Is this share price or market price? Is that not calling market price? So you use whatever it has been given to you, market price. Then you create a column for total market value, beta value, then the weights. B, C equal to A times B. This is D. This is E equal to C times D. Okay. So we have, what are the name of the companies? Dashing, D, E, F, G. So D, E, F, then G. Give me the number of shares for Dashing PLC.
60,000.
I can't. Did you say 86?
60,000.
60. Next one.
80,000.
Next.
100,000.
And the last one.
125,000.
125. Then the market price Market price of dashing.
4.29.
Pardon?
4.29.
Okay, 4.29. Next one.
0.90.
0.90.
2.92.
2.92. Next one.
0.17.
2.17.
3.14.
Then for Godi, 3.14. Thank you. Before we get the market value, let's indicate the beta value. What's the beta value of dashing?
1.16.
1.16.
1.16. Next one.
1.28.
Next.
0.90.
0.90. And the last one.
1.50.
1.50. Okay then. So to now get the market value, 60 multiplied by multiplied by 4.29, what do you get?
257,400.
257,400
7,400.
multiplied by 1.16. Yeah. Are we still together?
298,584.
584.
584.
584. 298,584. So the
Yes,
second
sir.
one, 80,000 multiplied by 2.92.
233,600.
233,600 multiplied by 1.28.
299,088. 008.
299,008. Then 100,000 multiplied by 2.17
21700.
multiplied by 0.9.
195,300.
195,300. The last one, 125,000 multiplied by 3.14.
392,500.
392,500 multiplied by 1.5.
750.
588,750.
588,750. Somebody should add up the total market value. Another person should add the total weight.
The total weight is 1381642.
133
1381642.
1381642. Okay. Then the market value.
$1,100,500. 11
Mm-hmm.
051.
11005.
Yes, sir.
500.
500.
1100500.
Oh, okay, 00. So the overall beta will then be equal to the total weight divided by the total market value, which is equal to, let me write it on the next, let me put you to the next page. So equal to 1,381,642 over 1,005,1,00500, which is equal to 1 point what?
26.
1.26. Recall from the requirements, examiner is asking you to calculate the risk of the portfolio relative to the market. That is, you are supposed to compare it with the market's risk. And you know that the risk of the market is always 1. Okay? Therefore, I would then say the risk of the investment portfolio is 1.26, which is higher than that of the market. That is 1. Okay, that is 1. So that's that, which means that the portfolio, the investments portfolio is riskier than the markets. That's interpretation. So that's that. The number B part of the question, Bernard has to recommend, given your reasons, whether the composition of the company's short-term investment portfolio should be changed. Your relevant calculation must be shown. So examiner is asking you whether they should change the composition of the investment portfolio. So in this case, what are you supposed to do? In the question the examiner has given you, in this question, you are not given the expected return, but there's information to calculate the expected return, because you are given returns, but there are in twos. You are given return on the dividend, you're also given return on capital gain. So to get your expected return, what you are supposed to do is to add the dividend yield. Yield is the same thing as return. So you add the dividend yield plus the capital gain yield. So that will give you the expected return. Okay. So quickly, because of time, let's calculate number B. Calculating alpha value. What's wrong with you now? Don't start again. Okay. So to get the alpha value, I will create a column for the companies. Expected return, required return, then alpha. You can put a comment if you want. Okay, I have D, E, F, and G. Right? Okay, So let's go and calculate the expected return. Calculating expected return, ER. So to do this, examiner has given us two different returns. So we have company, we create a column for dividend, yield. Let me push it down. Capital gain, yield. Then we have the expected return. So for D, E, F, G, dividend yield is what?
6.10.
6.10. Next one,
3.40.
3.4. Next,
5.70.
and the last one,
3.30.
3.30. Then the capital gain yield is what?
13.4.
13.4,
20.6.
20.6.
11.8.
Okay, next one,
19.7.
19.7. So let's add the two together to get the yield. Sorry, the return. Yeah, 6.1 plus 13.4.
19.5.
That's what? 19.5%.
0.5.
The next one, 24.0. Then 5.7 plus 11.8. That's
17.5.
17.5. And the last one, that will be 23, right?
Yes, 23.
Okay, so I will then come back here. The first one, the expected return is 19.5. Here is 19.5, followed by what? 24. 24.0,
17.5.
17.5, and the last one,
23.
23. So we need to go and calculate the required return. Okay, so let me underline this. Calculating the required return, RS. So in this particular question, there is no need for you to calculate the beta value again, since beta value of individual security is already given to you. So no need to calculate it again. Therefore, I would then say, I want to calculate the capping. All right, so RS equal to risk-free rate of return plus beta into market return minus the risk-free rate of return. So for D, for dashing, the risk-free rate of return is what?
11%.
That's 11%. The market return is 19.
19.
So here is 11 plus the beta of dashing. Beta value of dashing is 1.16. 1.16. Market return is 19, then minus 11. Give it to me. What do you have? What's the answer? 1.1, 20.28%. So for elegance, 11 plus the beta of Elegant is what?
1.28.
1.28. The difference between 19 and 11 is 8. Therefore, 1.28 multiplied by 8 plus 11. What do you have?
21.24.
21.24%. Then I will go to F. Fantastic. 11 plus what's the beta of Fantastic PLC?
0.90.
0.9 into 8. So what's the capping?
18.2.
18.2%. Then for Gordy, 11 plus the beta of Gordy,
1.50.
1.50 into 8. What's the beta?
23.
Pardon?
23.
23.
23.0%. So now that we have computed the required return, so let's go and put it there. 20.28 is the first one. 20.28, followed by the next one for E.
21.24.
21.24. The next one,
18.20.
18.20.
20.
And the last one is 23. Okay. So 19.5 minus 20.28. What do you have? Minus
Minus 07.
0.78. Next one, 24 minus 21.24. That's
76.
2.76. The next one, that's
Minus
0.
0.7.
Minus 0.7. Okay. 0. All right. So that's that. Of course, once it is negative, it means it is overvalued. Okay. If it is positive, it is undervalued. Overvalued. Properly valued. Okay. So you need to interpret your research. Examiner is asking you, according to the question, examiner is asking you to recommend, giving your reasons, whether the composition of the company's short-term investment portfolio should be changed. All right, so you need to advise. So interpretation. Or just say advice. Number 1. Okay. You then say the shares in Dashing PLC and Fantastic PLC are overvalued. Therefore, the shares or the securities should be sold. Number 2, the shares or the securities in Elegant PLC. The securities in Elegant PLC are undervalued. Hence, Hence, more of the shares should be bought. Okay, more of the shares should be purchased. Then number 3. So the shares in Godi PLC are properly priced, are properly valued. Therefore, they should be kept. Therefore, the company should hold on. The company should hold on to the securities. Okay, so that once the price increase in the future, we dispose it of. Securities, hold on to the securities. All right, so that's that. That's what we need to do. All right, so that's it. Then the last one, the last part of the question, number C. Another bonus 5 marks here. Examiner is asking you to discuss the factors that a financial manager should consider when investing in a marketable security. So you need to put yourself in a position of a financial manager. So you have some idle funds that you want to invest in marketable securities. Marketable securities involve those securities that can be that have 1 year or less. Okay, they have a tenure of 1 year or less, like treasury bill, like bankers' acceptance, like commercial papers and all of that. Those are marketable, short-term marketable securities, all right? They have a duration or maturity of about a year maximum, okay? Now, you want to invest in, say, for example, treasury bill. What are the factors you need to consider before you can say, before you can commit your funds into investing in treasury bill? What are those factors? That's what examiner is asking you here. Okay, for factors. Of course, when you want to invest, let me ask you. Don't let me. I don't want to be too forward. Yes, I need one of you to tell us what are the factors we need to consider. Give me one example. Okay, maybe I should start. Number 1 factor. Pardon?
I'll consider the interest rates and the duration of the investment.
tenor. Okay, first thing first, to consider the capital investments. You consider the initial investments. All right, that's the starting point, because if you don't have the funds available, you won't be able to invest. It's because you have the capital. That's why you are thinking of investing in treasury bill or in marketable security. Okay, then of course, when we talk about the tenor, what's the duration or maturity of the funds, of the investments? Is it for 3 months? Is it for 6 months or 1 year? So you need to you need to consider the tenor. Yes, what else? Number 3 is what?
Interest rate.
Interest rate, the yield. Okay, talk about the yield. Because before you commit your funds in marketables in treasury bill, first thing for those of you that are bankers, you know, of course, when the cycle for treasury bill, the TB is on, what your customer usually do is to send in an email instruction to say, please, when is the cycle for the next TB? Okay, this date. Okay, please. Then the customer will send you an instruction. Please debit my account with so much let's say, for example, 5 million naira and invest in a TB. All right. So that's the instruction. But before that, before the instruction, your customer would have asked you, what is the return or what is the interest rate on this? I think a few days ago, I think I heard in the news that government is increasing the interest rate on the treasury bill. All right. I think the last one they did was around 18 point something percent. I think I heard a few days ago that they've increased it, or I don't know the details, but the bottom line is that, of course, it's one of the factors. Okay, you must, because before you commit your funds, you want to know how much are you going to earn. If the rate is okay for you, if the interest rate or the yield is okay, you invest. If not, you ignore it. Just you are less concerned. All right. So number 4, what are the other factors? Give it to me.
The risk of return.
The risk, or did you say
The viability of the
The
company.
risk associated with the investment.
the risk in this case is default risk? Default risk. Okay, the default risk is the inability to pay the principal and the interest as a when due. All right. So the inability to pay the principal and the interest, that's the default risk. If you're unable to get your money back and the interest, then you also need to, it's one of the factors. Do you, I mean, will you be able to get your investments, your capital back, including your interest? So all of this you need to consider. Then number 5 is what? What about the liquidity of the investments? Okay, you also need to consider the liquidity. The liquidity is the ability to convert the investment to cash when the need arises. Okay, when you need money, what do? You dispose of your investments, then you get money in return to do whatever you need to do. So the investment must be liquid for you to be able to do that. All right. Then number 6 is what? What about foreign exchange? All right. What about foreign exchange? If the investment is denominated in foreign currency, then you need to consider how volatile the price, the value of your investment will be. All right, because of course, if the investment is denoted in denominated in the foreign currency, it may impact your investment. Then number 7, we consider the impact of inflation. All right, impact of inflation. And also taxation. Let me merge the two together. Part of inflation and taxation. All right, because the inflation will impact will affect the purchasing power of money. All right, the value of your investment will drop as a result of inflation. All right, so you also want to know whether you are going to pay tax on the investment, knowing fully well that if you dispose of your investments, you may pay you are going to pay capital gain tax. All right. If you dispose of your investment, you are going to pay capital gain tax. When you earn the income, with the income be tax deductible, all of this you need to consider it. All right, before you make the final decision. So these are some of the, of course, government policy is also inconsistent. Government policy is also part of the factors that you need to consider. I can list about 10 of them, but this is okay. So once you're able to list like 5, you are good to go. All right. If you're able to list like 5, you are good to go. So that's the end of the question. Let me know if you have any question for me before we close the class. So when next we are meeting, we may likely have valuation, business valuation. We have valuation and risk and uncertainty outstanding. So Friday is this coming Friday is Good Friday, which is public holiday. Then on Monday, there's also public holiday. So I may likely have you, I'm going to have you on Monday, not I may likely, I'm going to have you on Monday. We also have class on Sunday. We don't have lecture on Sunday, but because we have outstanding that we need to cover, So I may likely have you on that Sunday in the evening. All right. So because we need to.
What would the topic be?
Now we do have
if you
CR
take
in the evening. So I don't know the time you're looking at.
Pardon?
We do have corporate reporting in the evening on Sundays. So I don't know if
No, what I said was that lectures on Sunday will be done on Friday. Those that are
okay.
supposed to have lecture on Sunday, because Sunday is Easter Sunday, and there's nobody. Equity is not conducting lecture on that day. All right. So
Okay.
instead of the lecture you are supposed to have on Sunday, we are going to have it on Friday, this coming Friday. So that means on Sunday is free. But what I'm now saying is that because we have outstanding some classes that we miss, so I may likely have you that Sunday evening, just to make up the classes that we have missed. All right. But on Monday, certainly,
Sunday.
I said Sunday is Easter Sunday. You are no lecture
No
on that
class.
day. The lecture
Okay.
I want to have is my own, it's a personal thing, not from equity. It's because of the classes that we miss in the evening, not in the morning. In the evening on that Sunday is when we are going to have it. All right. Then Saturday, normal lecture we'll be conducted on Saturday. So yeah. Okay, again. Thank you everyone. I will see
Thank
you
you,
next
sir.
time by the grace of God. Good night.
Good night.
Yeah.
Yeah, good night.
Good night.
Nice.
Good night.